Investment properties can be a great way of building wealth. I'm going to share some of the tips that have worked for me and for my clients over the years in successfully using investment properties to get to where they want to be. First one, each investment property has to be treated like its own business. It has to have a purpose, what you're doing it for. Now, the first step with that becomes open its own bank account. Each investment property, they all have the same things and it gets treated like a business, like revenue and expenses. Instead, you've got rental income coming in, and then most people typically have the same things. They've got interest income, expenses, agents' expenses. It needs to have its own bank account. Too often I've seen, especially if I relate this to your typical, like a sole trader, often tradespeople do this where they just have all of their money all piling into the one bank account. So where they've got clients paying their bills and other things like that. They're buying their Bunnings receipts, but they're also doing their weekly shop at Coles, all from the one bank account, and that becomes an administrative mess. There's probably going to be accountants and bookkeepers shaking their head watching this. So give it its own bank account. The reason for that is that we can now, it's a lot easier to track what is going on with this own entity on its own. And I'm not talking about structuring, and that's a whole other discussion about do you hold it in a family trust, personal name, company, that's a whole video. But give it its own bank account where the rent goes in and the expenses go out. Typically, if you can have the mortgage taken out from that bank account, that's great. And I know some people are thinking, well, what if it's cash flow negative? What you need to do in almost every case is give that investment property, mess that one up, give it its own cash flow buffer. Just like with normal businesses, there's typically some cash flow buffer for if sales go down for a period, if there's emergencies. When it comes to investment properties, what actually happens, sometimes you will get vacancy that's not covered by tenancy, by your landlord's insurance. There might be some unexpected expenses that the insurance might not cover. Anything could happen. When it comes to that, it becomes far, far easier to manage. And from a personal perspective, you will actually know what this investment property is actually costing you. So and I'm just making up a figure, but if you've got a certain amount, it might be 3 to 6 months worth of rent that's just sitting in there. If you can get it offsetting one of the other loans or something, that's a separate story, but it makes a lot of sense to have that. Now, I know some people are wondering, well, what if it's cash flow positive or cash flow negative, but then tax positive or tax negative, because negative gearing is a huge part of it. Now, what I do tell people is the same principle applies. The only difference is in this situation is after the tax return comes in, the amount of extra tax that you've saved, whatever it is, as a result of this investment property, just chuck it straight in to this business account that is functioning solely for the purpose of this investment property. So you'll know, is it costing you money? Is it making you money? It'll also become far easier from a tax planning perspective. I know there's some people out there who keep their spreadsheets with every little receipt of everything that comes in, but if you make a rule that every expense that comes from that relates to this investment property is taken out of this account, I promise you will have a far easier time come tax time. And then it also becomes very, very straightforward. After you've made the adjustment about the amount of tax that you put back into the account, it becomes really simple to know, is this property putting money in your pocket or is it taking money out of your pocket? There's nothing wrong with either one because that's the income. And then we've got the capital gains. And then it honestly becomes a simple matter of just looking at what is the property worth? What did I buy it for? The property minus expenses. So that will let you actually track what this investment property is actively doing for you. So, most practical tip you'll ever get on how to manage investment properties.